How can you protect yourself to make sure that the investments that you're in don't go into bankruptcy or don't have any troubles or issues at all? It's no surprise out there that was a deal in Texas that did not do well. They were over leveraged and the company went bankrupt. You have to analyze the financing. Is the financing loan to value or loan to cost? I want to talk to you about the difference between loan to value versus loan to cost. Which one's better? Now, loan to value is, imagine if your multifamily investment is $10 million. The bank will finance 80%, so they'll finance $8 million and you have to come up with the $2 million. But let's just say you have to do $500,000 of cap X. What do you do? Well, some banks will do a loan to cost, which means they will loan you 80% of the value of that 10 million and 80% of that 500,000 for improving costs, building value into the complex. Because under the underwriting, the bank believes that your property will value at $10.5 million after it's being renovated. Now, some banks might not. And if the banks do not do a loan to cost, that means part of their underwriting, they don't even believe that your property will be worth that much after it's been renovated. So there's a discrepancy between the difference. So usually what does the operators have to do? The operators now, instead of having 80% of that $500,000 finance, they have to raise that $500,000 from investors, which as an investor, it may not be as good because then you don't get as much equity in the deal or the deal becomes a little bit more liquid because it takes more money, so the returns tend to come down. So usually, if everything is the same, it's always better to have a loan to cost loan versus a loan to value loan.